All right. So just a real quick, who are we? Tax and Financial Group is a full-service financial services firm. We're financial advisors providing financial advice to business owners and to individuals related to a variety of things that are investment, insurance, financial planning related. And as Andrew mentioned, we are very, very committed to working with individuals and business owners, but we do have a lot of different clients that are here in the southern Orange, or in Orange County in particular, Southern California area. A couple of things that I'll just tell you quickly about our firm. Our firm was founded over 50 years ago, and it has been a pillar in the community in Orange County. We're ranked in the top 10 from Orange County Business Journal in terms of top 10 financial advisors and brokers. But we're also very involved in our community. We have many individuals who are actively involved in different community organizations. One of the things that we're proud of is every year we do a golf tournament, and we've raised over $2 million for Make-A-Wish Orange County. And so we're really excited about our partnership with them over the years and the work that they do. So we're going to talk about a couple of things today, just general tax strategies and some information about the Tax Cuts and Jobs Act that was passed. Now it seems like a long time ago because COVID has turned 2020 into the 36-month year. But we're going to just cover a few of those things and then a few other ideas or bits of information that we might be looking for going forward. So before I jump into the detail stuff, I think Deborah has got a poll question that she's going to throw out there. We just want to kind of gauge the audience today and see what kinds of things you might be most interested in. And so we're just going to ask you to let us know, are you a business owner, are you a partner, or not? Are you an employee but not an owner?
Okay. Can everyone see the screen? Hit your poll in. Okay. Still going? Oh, yeah. Looks like it's about 50% business owner or partner. I'll share this as soon as it's finished. We have 13 out of the 17. It looks like that might be it. Go ahead and end it. We can share the results. Oh, one more. Sorry. Give it just another couple of seconds and then I can share this. Looks like it's 47% yes.
Good. A pretty good split though, business owners and non-business. So we are going to talk a little bit about both sides of that. Perfect. And we're going to be glad to address some of those things. Some of the seminars that we do that are specifically business related get a little bit more into the weeds on the tax issues for business owners. But what we find is that everybody has to file a personal tax return. And so starting off there tends to be a good spot. So what I want to do is just maybe start with a couple of basic things. And we hear a lot of confusion about tax rates. And we will ask individuals that we work with, how much, what is your tax rate? And the most helpful thing for us is to be thinking about how can we move you through various planning strategies from a high rate to a lower rate. But what it means is that if you're earning an income, and I'm just going to think about this from a single person or from a married person. If I'm a married person and I've got a household where my income is between $326,000 and $414,000, I'm going to pay at a 32% rate. But that doesn't mean I pay all of my tax at that rate. What it really means is that the first $19,000 I pay at 10%, the next $60,000 I pay at 12%, and so on until I get in there. And so what we frequently are looking at is for individuals who are just about to bump into another rate or rate bracket, they want to manage that and they want to stay in a lower bracket so they don't start getting assets or income taxed in that higher rate. And so one of the things that we'll always talk about with clients is how that bracket affects you. Now, what I'll say is, if you were to bump up and earn $327,000 that year, you're not going to pay 32% on all $327,000. You're really only going to pay it on that extra $399. So it's an important to really understand how taxes work and understand where they work for you. So when we think about taxes, what we're first doing is we're defining what is income. And the thing that we look at there is everybody realizes that the income they take in their W-2 is income. So compensation, commissions, fringe benefits that you might be getting, those are all income. But we're sometimes surprised that income that you take out of a pension or a qualified retirement account, like when you get to retirement and you take money out of your 401k, that money is also counted as taxable income. And so we know we're going to pay ordinary income taxes on that as well. Now, you might have gains from the sale of property. You might have stocks or bonds that you've owned and you sell them. You might have real estate or other kinds of property that you've sold. And when you sell property, that's also income, but it's usually a different kind of income. It's called capital gains. And capital gains currently are taxed at a lower rate. Right now, the maximum capital gain rate is 20% for an individual. And as we saw just a minute ago, the maximum income tax rate is 37% for an individual. And so we know that we're looking at where these things could change and how these rates affect us. So I know that I might rather pay capital gains tax at a lower rate than pay ordinary income taxes at a higher rate. So I want to maybe just pause for a moment in the technical discussion and make a comment. This is not intended to be political or in any way reflection on what's going on with the election. But what we do know is that there are certain things that can happen once the election is over and we've got results and we've got new people sworn in, whether it's the Senate, the House, the White House. We know that tax law requires laws to be passed by a majority of Congress and then signed by the president. And so as long as we can get some agreement, we may have tax law changes going forward. If we're not able to get agreement between the Congress and the White House, then we might have sort of a stalemate. And so we want to be careful to watch what's going on and watch carefully, but we want to be proactive in terms of the planning that we do as well. One of the changes that has been discussed is changing how capital gains are taxed as income and raising the top capital gains rates for people in that 37% bracket to raise that up to a 37% rate instead of a 20. So depending on your tax bracket, it could have a significant impact. If you're in one of the lower brackets, it may not have an effect on you at all. And that's why we find it's really important to know where you stand for your income tax bracket. If you have interest from savings bonds or CDs, or you get interest from different kinds of bonds, those are also going to be taxable income. And any rent that you get, if you own rental real estate, you know that that rent is also subject to income taxes. So when you're doing your taxes, what you're looking to try and do is, first of all, quantify how much income are you actually getting and what bracket would that put you in. Now, there's some things that are not taxable as income. So we know that if, for instance, you put money into a Roth IRA and you begin taking distributions out of that, that Roth IRA is not subject to income taxes when you take the money out. And that's a pretty good deal. So anybody that's eligible to contribute to a Roth IRA or to a Roth 401k, if you've got that option with your company's qualified plan, those are things that you might really want to consider, because as that money grows and gets bigger and bigger over time, all of the appreciation, all of the income that is earned on those deposits is also tax-free. And so when you get to retirement, you don't really want to have all of your eggs in one basket. You don't really want to have all of your income coming to you that is taxable, because that's going to push you up into the highest bracket. What you want to do is have a combination of sources of income. Some of them are going to be ordinary income taxed, some of them might be capital gains, and some of them might be tax-free distributions. We also know that income from municipal bonds and distributions from life insurance policies can all be tax-free for income tax purposes. There's a lot of reasons that your taxes matter, but one of the things that's important to understand is that your Social Security benefits also intermingle with what your taxable income is. And so if you are earning income and also receiving Social Security, or if you're taking distributions from a pension or a 401k and you're also taking Social Security distributions, some of those Social Security benefits will be subject to income taxes. And that's another reason that it's important to look at how you're distributing your income and whether or not it's subject to tax. All right, so now that we've calculated what's going to be included in my income, the next thing I want to do is I want to find out how can I get my income down to the lowest number possible. And so then we're looking for different adjustments and deductions. So there were a lot of deductions that were available, but some of them have been limited by the Tax Cuts and Jobs Act. One of them that was limited is if you've got a spouse who's a teacher and they were able to pay for certain classroom supplies, their deduction for those supplies has been reduced. If you're moving across country, as Andrew said, I am born and raised in Minnesota, so the Midwest, moved to California, and that's not a cheap move when you have to put all you own in a truck and hire a logistics company to get you here. So you guys all know that. Moving expenses used to be deductible, they're no longer deductible. So that's one of the changes that happened under the Tax Cuts and Jobs Act. Student loan interest is deductible for certain loans. Also, self-employed individuals that have health insurance deductions, those can qualify as these deductions. And your HSA contributions, if you're in a high deductible plan and you've got an HSA, you can contribute to that as well. And all of these things are going to help you reduce your income and ultimately reduce your income taxes. So the next thing we look at is the exemptions. Individuals have personal exemptions that they used to be able to claim. Under the 2017 Tax Cuts and Jobs Act, the exemptions were eliminated, but as you'll see in a moment, the standard deduction was increased dramatically. And so the 2017 Jobs Act changed some things for the better and some things for the worse. So that's one thing where you really want to take a look at how that affected you. And then here's a thing that maybe you want to be focusing on or thinking about. If you've got children who are under age 17, you have the ability to take a $2,000 per child tax credit. And tax credits are great because they work against the actual tax. It's not a reduction in income, but it's a offset on actual taxes paid. Now, the reason I said you might want to watch this is because there's a proposal that may get some traction now after the election to increase this child tax credit up to $8,000 per child. And so that'd be an interesting change. And that I believe is being proposed to occur during the time where people are being impacted by the COVID economic or having an economic impact from the COVID virus. Now here's where I said the deductions went up dramatically. In the past, the maximum deduction for a family, the standard deduction was about $12,000. Today, married filing jointly, your standard deduction is $24,800, almost $25,000. So that deduction went up a lot. And you want to make sure that you can take that, determine whether or not you can take that standard deduction. Now, if you've got a lot of other deductions, maybe your mortgage interest is being taken out, or you pay state and local taxes, your income taxes to the state of California, for instance, all of those things can be added together. And if your mortgage interest, your state and local tax deduction up to $10,000, your medical expenses, your charitable deductions, if all of those itemized deductions are higher than 24,800, you're probably itemizing, or you'll want to itemize those rather than take the standard deduction. But for a lot of individuals who don't have a mortgage, right now the standard deduction has been a really big benefit for them. One other change that we saw happen here, and this affected a number of individuals, but the top end of the mortgage interest deduction was capped. So at this point, you can still deduct mortgage interest, but only on a mortgage principal balance up to $750,000. So when we see really, really low mortgage rates, that isn't as big a deal. But for a lot of people where the mortgage is over $750,000, they're only allowed to deduct the interest on the first $750,000. I'm going to go kind of quick just because I want to get through the slides today, but I do am happy to take additional questions if we need to do that going forward. And as I said, the limitation that was imposed by the Tax Cuts and Jobs Act put a cap on the amount of income taxes and property taxes payable to the state or local government that you can deduct. So in California, if your income taxes were $40,000 and your property taxes were $15,000, that's a total of $55,000 of state and local taxes. Your maximum deduction is going to be $10,000. That's one of the areas where California is trying to see some change in that provision. And then one other change that we saw was the limitation for deductions from medical expenses. This is based on your adjusted gross income. And as we've talked already, if you're able to manage your adjusted gross income by designating or providing some of your income that would be non-taxable or deferred, this allows you to take a better deduction for various medical expenses. And so again, this is an area where as you're doing your planning for future retirement, for your savings, you want to be thinking about how can you manage your adjusted gross income to take the best advantage of some of these different deductions that are available. And then charitable deductions. So if you're going to make a charitable gift, and a lot of people now this time of year are thinking about giving to charities, the maximum amount that you can give to charity and still deduct is 60% of your adjusted gross income. And I've got a little asterisk or a little note here because in the beginning of this year when the CARES Act was passed, they eliminated the 60% limitation and they said, no, you can deduct up to 100% of your gross income. So that change is in place for 2020 only. But if you're thinking about making large charitable gifts, this is an area where you can definitely take a deduction against your ordinary income and reduce your income taxes. Because we know that there are standard deductions and charitable deductions, sometimes we're taking a look at ways where we could bunch up our charitable deductions and put all of our charitable deductions in one year and then sprinkle them out or spread them out to charity over a 2, 3, 4, 5-year period. And so we're seeing a lot of people setting up accounts that are called donor advised funds to allow them to bunch their charitable deductions, take the maximum deduction on their income tax return today, but distribute the income to their charities of choice over a period of years. And so that's one of the things that we're just looking at here. And I just saw an email that said if you're trying to set up one of those donor advised funds, you need to do it by December 15th or the paperwork won't be set up. We also see a lot of people using charitable trusts, and they're also taking deductions for things like volunteering, if they're delivering meals or if they're doing something else that's related to their charitable organization, they're able to deduct those things as well. we're not going to get into a lot of detail today about charitable trusts, but these are a great estate planning vehicle to allow people to take a highly appreciated asset and sell the property without paying the gains up front. They're able to sell the property, reinvest the principal, and take income from the trust for the rest of their life. And then after they pass, whatever's left in the trust will go to charity. So this is a really good strategy if you're sitting on a piece of appreciated real estate, if you've got stock that's appreciated significantly. Sometimes even businesses can be, you can use this strategy for the sale of a business. If you're in one of those situations, it's probably something we would want to talk a little bit about before you set up the trust and before you sell the property. So one other big change that happened earlier this year, and it seems like forever ago, but the Secure Act was passed. And the Secure Act made some changes to IRAs and 401ks. And specifically, the big thing that happened was the age for distributions was increased. It used to be 70 and a half, and now it's 72. So it's only an 18-month difference. But for those individuals that are thinking they used to have to take distributions at 70 and a half, they're now able to push those out until age 72. And then they have to start taking out based on their life expectancy. One other big change that happened is if you inherit an IRA from a parent or a uncle or aunt or somebody like that, it used to be that you could distribute that IRA to yourself over your whole lifetime. And depending on your age, that could be a 20 or 30-year period. The new rule under the Secure Act is you can only stretch the inherited IRA for up to 10 years. And if you want to take that money out faster, you can, but at a minimum, you have to take it out over that 10-year period. A couple of things that I'll point out. The CARES Act, we mentioned already, that also gave us a couple of changes. You do not have to take an RMD, a required minimum distribution, for 2020. And also, under the CARES Act, it's suspending interest payments if you've got a loan against your 401k. We have a lot of clients that used 401k loans this year to help with some cash flow challenges. These rules made it a little bit more flexible for how you could repay those loans, gave you a little bit more time to complete that loan repayment. So those are also good ideas or good options for individuals. I just mentioned this, eliminating the stretch IRA. It is still possible for an IRA to pass to a surviving spouse, and that ability of the surviving spouse to defer the IRA is still there, as well as for an individual who's a minor or who has an individual with a disability. And then the Secure Act made a few other changes, specifically expanding the ability to use $529 for other kinds of expenses. So that is kind of a nice thing. Sometimes individuals, we think they're going to college and they turn out not to want to go to a 4-year school. And so they want to use some of that $529 money for other kinds of expenses. So other educational expenses are in there. And then there are some provisions about pulling money out of a retirement plan to pay for childbirth or adoption related expenses. So we covered a lot of ground here in the session today, and hopefully it gave you just a few ideas or a few tips about what we do and some of the reasons that we want to start thinking about tax planning no matter where you are on the tax bracket chart. This is something that we think about when we're saving for retirement. It's something that we think about when we're selling off assets or looking at possibly transferring property. And there's a lot of different tax planning that we do as part of the overall financial planning process. But as we work with our clients, whether it's helping them to manage their investment portfolio or whether it's reviewing their various types of insurance and addressing their insurance needs, we find that using a financial planning model is the best way because it gives us a comprehensive overview of all the moving parts. And it's not just a one single topic approach. It should be comprehensive. And so as you're working with your financial advisors, what we encourage you to do is do something that is going to be very comprehensive in nature and look at how taxes will impact all of the other decisions that you're making for yourself personally and for your business.